Live.
Good morning, ladies and gentlemen. It is with great pleasure that we here at the Federal University of Minas Gerais, Brazil, receive Monsieur Pascal Saint-Amans, who has been for the past 10 years the director of the Center for Tax Policy and Administration of the OECD. Mr. Pascal Saint-Amans has been the leading actor in the largest transformation of worldwide taxation in the last 100 years. He has achieved impressive milestones. In 2 years, he concluded the BEPS projects, and with that, he gained respect from all the international community, not only because of the quality of what he's doing, but also because of the deliverance of everything that he plans to do. So it is with great honor and also thankfulness for what Mr. Pascal Saint-Amans is doing for the world in order to really making it better that we receive him here today. Without further ado, I would like to deliver the word to our lecturer and thank him one more time for his acceptance to our invitation. Monsieur Pascal Saint-Amans, please go forward.
Muito obrigado. Bom dia, André. Thank you very much for your very nice words of introduction. And I'm extremely happy to join you. I would be much happier to be with you in person, not only because I love Brazil, but it's much better to be in person and to interact. The COVID situation makes it impossible, and probably the amount of work we need to achieve to deliver the practical implementation of the pillars, Pillar 1, Pillar 2, we'll go back to that in a second, would make it difficult too, but very happy to spend an hour with you today. To start with, I would say, it's great to interact with Brazilian friends a few days after the OECD formally, and I would say finally, launched the accession process by sending a letter from the Secretary General of the OECD to the authorities in Brazil to invite Brazil to start the accession process. Acceding to the OECD is something that Brazil asked for now a few years ago. And for the OECD, not only it is an honor, but I think it also shows that the OECD can be relevant, but even more importantly, can remain relevant by having countries, emerging countries, and Brazil is one of the leading emerging economies. And this makes a link with the tax work, which I'm going to present to you, because the tax work over the past 10 years has demonstrated that we have to move collectively. I would say we have to find inclusive solutions, global solutions to the global issues we face. And tax is what I call a paradox. That's the tax paradox, which is that even though it's at the core of sovereignty, it has been the poster child of international cooperation, of multilateralism for the past 10 years, while multilateralism at the same time was challenged, not to say in crisis. So how come do we have an inclusive, successful tax story at the time where we have a crisis of multilateralism? And this tax paradox I explained by the fact that in the area of tax, cooperation is the only way to sustain, to support, to strengthen the sovereignty of countries. Why so? Because tax is at the core of sovereignty. Consent to tax is at the core of state building, of democracy. Tax, primarily because of that, is a domestic issue. But at the same time, we've had for the past 30, I could even say 40 years now, following, the liberal theory, economic liberal theory of Reaganism or Thatcherism, we've had globalization. We've been through a movement where all the borders, from a financial perspective, from an investment perspective, from a currency perspective almost, have been dismantled, which has created massive opportunities of investment, of growth, of reducing poverty in a number of countries, but also of putting countries at a point where they had to compete with each other to attract investment. When you suppress the frontiers on investment, on currency, on financial matters, the one borders which you can see are the tax borders. But at the same time, if you have some countries being able to reduce taxation for cross-border investments, you have extremely aggressive tax competition. This tax competition we could see on high net worth individuals who could hide their money. If I'm talking about Brazil, I guess that going south to Uruguay was an option, going north to Panama or further north to the US or far east to Switzerland was the solution, not to pay taxes in Brazil. And this was the result of lack of cooperation. Countries said, we are sovereign. We tax the people the way we want. We don't care about what happens across the border, which actually gave Switzerland or Panama a competitive advantage, because by not cooperating, at the time where it was easier to shift the financial assets, resulted in Brazil, which is a high tax country, to lose revenue. The other example, of course, which is probably the core of our conversation today, is about corporate income tax. Corporate income tax is extremely sensitive because that's what companies pay. That's the last charge before distributing the dividends to the shareholders. And therefore, there is a big sensitivity to corporate income tax, even though it's not the tax which yields the more revenue. VAT, and in a number of countries, personal income tax will bring more revenue to the state. But still, corporate income tax is important and extremely sensitive to companies. As a result of international tax competition, the fact that countries said, we are sovereign, therefore we do not want to cooperate because we want to exercise our sovereignty, and the fact that companies had become global players who could arbitrate one jurisdiction against another at a time where financial flows, where cross-border financial flows were facilitated, at a time where, with a more legalistic approach to business, you could more easily disconnect real activities and the intangible property, where you could shift the intangible property in low tax jurisdiction and keep the assets and the people, the payroll, in higher tax countries. All that has resulted in what we have called base erosion and profit shifting. So if you look at the history of it, you have a world where tax, being at the core of sovereignty, is mainly domestic, with no such thing as international tax, as international tax lawyers joke about when they start a course at the beginning of the year with their students on international tax. Ruth Mason, for instance, a great professor at Virginia University, said there is no such thing as international taxation. And that's partly true. What you have, or what you have had, because this is changing, is a model tax convention developed by the League of Nations, which was just dealing with the small frictions of double taxation with the tax treaty and transfer pricing rules. And all that was established in an old world, brick and mortar economy for sure, a colonial world. We're in the 1920s, and a world where multinationals were not very developed. And this world has, I mean, this framework has survived until a few years ago. The difficulty is that the world has changed. The framework has remained the same. The world, the underlying facts have changed. And that's where, at the end of the first decade of 2000, we've been able to realize, to see what was obvious, what was, I mean, in front of the eyes of everybody, that the international tax rules were no longer fit for purpose. But it takes an event to just wake up and realize. You know, it's like you drive, maybe not in Brazil where the landscapes are quite dramatic from one place to another, but in France you move from Paris to Bordeaux, and while driving you don't realize every kilometer that the landscape is changing. But when you arrive in Bordeaux and you look at the landscape, it's very different from Paris. And here is the same. We've driven for years and the landscape had changed, but we had not realized that. And what was the eye-opener event was the global financial crisis in 2008. Massive crisis which questioned the financial world, the financiarization of the world. And also, and we can see it today with populist movements. I know I'm talking to a Brazilian crowd, so you know what populism can do. But we've seen that in Europe, in the US and elsewhere, a rejection of multilateralism, the need to go back to your community, the feeling that open borders was not that good to everybody. And that was the wake-up call in 2008, 2009, which translated into a change in global governance with the emergence of the G20. At the summit level, the G20 was created years before to deal with the Asian financial crisis, but there it was on the 15th of November 2008, escalated at the level of the leaders. And that's important, Brazil was not in the G7, is in the G20. That shows the shift in the global governance, which opens up to big emerging economies like Brazil, China, South Africa, Russia, Argentina, Indonesia, which currently chairs the G20, and a couple of others, India, of course. But the financial crisis with the change of governance came up with, or allowed us to start work on renovating these international tax rules, which were no longer fit for purpose because of the change of landscape, which I have referred to. What have we done and where are we today? I mean, the first attack, I would say, to use military language, was on tax havens from the perspective of lack of cooperation, offering bank secrecy, offering shady businesses through trusts, through bank secrecy, through opacity, through the lack of information, the beneficial owners. And that's where we started the inclusive process to respond to the G20 request, and because the issue was global, building the Global Forum on Transparency for exchange of information for tax purposes. This Global Forum providing for a peer review to make sure that countries would put an end to bank secrecy. We've done it. Today, you have more than 100, I think it's 101 countries, which are doing automatic exchange of information. You have 163 countries which are doing exchange of information on request. And they are all doing pretty well. You have a few countries lagging behind. Panama is still there. We hope that they will really change. They started a real change and seems to hesitate. So I encourage them to move forward. But overall, it's done. I mean, we had last year, I think, 80 million bank accounts exchanged throughout the world, for a total value close to 10 trillion euros. So thing which has resulted in competent authorities, in tax administrations knowing each other. When I started years ago, too long ago, in the French administration, and we had to write to another competent authority, we just didn't know the people. we would write letters which would come back indicating that the competent authority had changed. When the guy was not dead, it happened that we had to return saying, no, sorry, the guy was dead. So we didn't know who we were talking about, which was a good illustration of the lack of cooperation. Now people meet. I mean, they used to meet physically in Paris before COVID, but it will soon resume. They meet every now and then. They know each other. They exchange information. When you talk to people, when you meet them, it completely changes the dynamic. But if you want to address tax haven, you had another issue to address, which was what we called, and we made up the acronym. I must say I'm responsible for that. In 2012, we launched the so-called BEPS project for base erosion profit shifting, because we know that the tax competition was not only on providing high net worth individuals with the opportunity to hide their assets, but it was primarily about letting companies shift their profits to low tax jurisdictions, keep the expenses in high tax countries to deduct them, and shift the profit through several techniques. And what the BEPS project demonstrated was the fact that we had a holistic issue. It was not about one loophole here or one loophole there that we could have closed. It was systemic. We had to change the system. Thus, the pretty comprehensive approach and action plan that we developed in 2012 and got approved by the G20, you see, the G20 again, in 2013, which included 15 actions, divided in 3 categories. The first category was about addressing a real issue in the international tax framework, which was a gap between the sovereignties. As I indicated, sovereignties interacted through tax treaties to limit the frictions of double taxation. But there was no rule, no international rule to articulate the sovereignties. What do I mean by that? If you're a global taxpayer, you could easily, in this world without tax regulation, lend to yourself, parent company lending money to its subsidiary, through a hybrid instrument, a loan convertible into a share, a bond convertible into a share. And in that case, you have in one country an interest which is deductible, in the other country a dividend which generally is not taxable. And by doing so, lending to yourself, what did you get? You got a tax credit. And the country where you had the loan said, well, but that's a bond, so it's an interest. I'm not losing anything. The country where you had the lender said, well, that's a share, and therefore a dividend, I'm not losing anything. And the taxpayer said, no, you're not losing anything, but I'm gaining a lot. Why? Because you had no cross-border approach of the domestic tax policy. I use the example of hybrid mismatches that you have recognized, but that was the same with interest deductibility. That was the same with the number of harmful tax regime. And that was the same with the weakness of CFC legislations. That's the first part. Action 2, 3, 4, 5 that you have recognized were designed to address these, to come up with a new set of international tax rules about making sure that when you design your domestic legislation, you think of what happens across the border. And to solve the issue of hybrid mismatches, then you stop saying, not my business. Say, okay, it's an interest, but is it taxed on the other side of the border or not? If not, maybe I should requalify this into a dividend, which will not be deductible. So that's what we did, and we came up with model rules. And I think the model rules on Action 4, interest deductibility, on Action 5, of course, on limiting the negative spillovers of rulings by making them, if not public, but at least shared with the other administration so that we would move away from the secret rulings which were so harmful, or on Action 3 on hybrid mismatches. The model rules we developed did create a new set of international instruments. The second batch was about fixing the existing rules by trying to come up with the rules to put an end to treaty abuse, to treaty shopping, and to fix some abuse of the permanent establishment definition. You recognize Action 6, Action 7, and then to fix transfer pricing rules, which we know are good per principle. I mean, you know, you may not agree. I know there is a debate. There was a debate during the establishment of the rules by the Commission of Economic Experts in the 90s, who hesitated between unitary taxation or the arm's length principle, obliging companies just to mimic the market and pretend that internal transactions can be done at arm's length. And that probably works, the arm's length principle, in 80% of the transactions when you have pure routine. But when it's about, especially in the modern economy where the value is on intangible, when it's about intangible, it doesn't really work any longer. We tried to fix it. Not sure we did the job perfectly well because countries are extremely conservative. And we ended up with the DEMPI, which was a way to say you cannot shift your profit to a country where you do not have the activities, where you do not have the real people doing the real research, which was a way to put an end to, the pure boxes where you have no activity of any kind. That was the second set, partially successful. Probably more successful on the tax treaty front because we came up with a multilateral instrument which was unprecedented in terms of amending bilateral treaties to move fast. The third set was about improving information, transparency. Action 11, trying to find the data and share better the data. Action 12, extremely important, and Action 13 and 14 as well, on country-by-country reporting or by mandatory disclosure, and finally, by improving dispute resolution mechanisms, transparency from the tax administration to the taxpayer. On the top of that, we had to address the issue of the digitalization of the economy. And I would say that in the first phase of the BEPS project, we failed to find a solution. We succeeded in saying there is a problem that we need to address. And that's where we were in 2015 when we delivered the BEPS package with the obligation to be more inclusive. The BEPS package was developed with the OECD and G20 countries. Developing countries complained, rightfully so, that they had not been enough involved. They had been consulted. They were a consultative process, but not on an equal footing. And we decided to bring developing countries, interested developing countries, on an equal footing, which is what happened in June 2016 in Kyoto, in Japan, where we had many developing countries joining. And today, as you know, we have 41 countries on an equal footing in the inclusive framework for BEPS implementation. But the story doesn't stop in 2016. Actually, the story was writing the history, or writing the story, has been quite active since 2016. The past 6 years, there has been the agreement that we had to go further. I mean, first we had to implement the rules, to monitor the implementation of the rules, to do peer reviews, which is what we do. But we were left with 2 or 3 main issues. As I said, the transfer pricing thing was not resolved, which means that the big IP, intellectual property, the big money linked to that was still in no tax jurisdiction. And I could even say not only still, but increasingly directed to low tax jurisdiction. And that may be one of the unintended consequences of the DEMPI approach, which was to say you need to realign the profit with the activities. And actually, in some cases, what happened is a realignment of the activities where the profit was. Shifting activities to Ireland, where the idea was not really this one. So that was a serious challenge, as was the case of the harmful tax practices work, which said you need to dismantle the regimes dedicated to attract mobile foreign investment, and which have resulted in fiercer tax competition by saying, okay, I cannot target the regime, I open it up for everybody, which was not the goal. Or regulating patent boxes, which ended up having more countries adopting patent boxes. So we could see that this challenge remained. Another challenge we had was related to the digitalization of the economy. No solution. Google, Facebook, and the likes acting with no permanent establishment, or where they have a permanent establishment, just a cost plus to limited functions, while all the revenue derived from advertisement, if you take Facebook, or subscriptions, if you take Netflix, were registered in Singapore, Ireland, or Panama, or wherever, low tax jurisdiction. The third weakness which we had to address was that there was the feeling, and that's linked to the first one, harmful tax practices, that tax competition was still there. There was still this race to the bottom. When you look on the long trend at corporate income tax rates, you can see that they're lowering to go to low levels, where 20 years, 30 years ago, 50% was almost the average. We've moved to something in the 10s for small countries, something in the 20s for larger countries, but very far from what it used to be. So against that background, we pursued the work. And another paradox is that this work was pursued because the United States of America, which usually is not a key promoter of multilateralism and has very much of a unilateral approach, the United States, under the Republican administration, which really is paradoxical, decided to implement the BEPS project. They slashed the rate from 35 to 21%, they broadened the base. They imported the BEPS measures, and they even went further. In particular, by challenging transfer pricing rules, even though at the end they remain within the existing framework, just introducing the BEAT, base erosion and anti-avoidance tax, deduction of interest where there is the presumption that there is too much profit shifting abroad, so an outbound limitation. And they, even more importantly, introduced a minimum tax. They moved from a worldwide taxation system, which was actually no longer worldwide because of check the box, meaning that offshore profit were no longer taxed in the US, and the CFC, subpart F, was no longer effective because of check the box with 3 trillion US dollars. It's a massive amount, $3,000 billion of profit located in Bermuda, Cayman, and zero tax jurisdictions. So they had a worldwide taxation in theory, but a pure territorial system in practice, and they decided to move to a system where the rate would move from 35 to 21, where they would move to a territorial system, but that's a big change, with a minimum tax, introducing a real worldwide system with a global intangible low tax income, GILTI, at 10.5% minimum, calculated on the effective tax rate abroad on average across jurisdictions. So the US introduced BEPS and went beyond BEPS. And in their debate, started to challenge the transfer pricing with a conversation, which went to a bill adopted by the House, even though it was not adopted by the Senate, on the destination-based cash flow tax. And this change in the US triggered the conversation at the OECD, which quickly turned into a two-pillar approach. And I will start with pillar 2, because a number of European jurisdictions, let's mention Germany or France, which are high-tax countries, said, come on, the US, the Republican administration, has been able to put in place a minimum tax. We want the same. We want to establish a minimum tax, in particular in Europe, where you have extremely harsh competition, because Europe is very heterogeneous in terms of membership. France, Germany, Italy, Spain, high tax countries, Nordic countries, very high tax countries, Ireland, Luxembourg, Belgium, Malta, Cyprus, the Netherlands being low tax jurisdictions. Not to mention jurisdictions like Estonia with their distribution regime, where you're not taxed if you don't distribute dividends for ever. So these countries said, we want the same. And the US said, be welcome, be my guests. I have interest in you enacting minimum taxes because it levels the playing field. Feel free, go ahead, draw on my experience. And as regards the first pillar, because the discussion in the US on the distribution cash flow tax, the US agreed to say market jurisdictions need to get more. Economists will explain to you that the only thing a company cannot manipulate is where the clients, the customers are. You can decide to shift factories, to shift employment. You easily can shift the profit. You can move your assets. But the thing you cannot move is where your customer is. So if you anchor corporate income tax base a bit more on consumption, then you limit the risk of shifting. And that's the basis for the destination-based cash flow tax, which, again, was not adopted, but still was in the mind of many US people, especially as in the US context, you have a trade deficit country, which means that the tax base, if relying on consumption, is broader than the tax base relying on output on the one hand, and on the other hand, in a country where you do not have VAT, which means that you don't tax consumption. I mean, you tax it through local sales taxes. So in that context, the conversation resumed and was developed into two pillars. The first pillar being, how can we give more taxing rights to the market jurisdictions? And not only on digital. The Europeans, the French in particular, say the GAFA. GAFA is a very French expression. I'm not sure you're using it in Brazil. It's about Google, Apple, Facebook, Amazon. And sometimes you call them the GAFAM, adding Microsoft. He said, we want to tax the GAFA. And the US said, yeah, fine, but we want to tax Louis Vuitton. We want to tax all these companies deriving profits from the US. So we want a solution which is not ring-fenced to the digital economy, because that would be an unfair solution. That would be a distortive solution. That would be a discriminatory solution against the US. And that's where the conversation was built, and there was a recognition that the problem was a global problem, transfer pricing problem, and had to be addressed by a broader approach. Now, when do you recognize taxing rights to the market? And the consensus which emerged was to say, well, you do it where there is something like a marketing intangible, where you have value creation by consumption. And that was the basis for the blueprint we developed and adopted at the end of 2020. And this was not a walk in the park, as the Americans say. That was not an easy conversation, because we're dealing with the Trump administration, which was not always the most predictable administration. I think you can appreciate the understatement here, because the US was very favorable, and at some point, the Secretary for Treasury, Steven Mnuchin, very nicely but firmly said, well, this has to be a safe harbor. Translated into the solution has to be optional for companies. And there is no such thing as optionality in taxes. I even made the joke with Steven Mnuchin, I'm not sure I appreciated it much, with, okay, you want to make tax optional, could you make death optional, drawing, on the famous say that there are only two things sure in life, tax and death. And other countries didn't like it much either and said, okay, no way, it cannot be optional. The US, it is optional or nothing. And we at the OECD said, okay, fine, let's try to keep this alive. And that's what we did. And that's how we were able, at the end of 2020, to come up with blueprints for Pillar 1 and Pillar 2. Pillar 2, by the way, we had designed in a more forceful way than guilty, because instead of having an average approach, which still gives a premium to low tax jurisdictions, because you can average what you put in Brazil and what you put in Cayman Island, and the average will be above 10.5%. What we said has to be taken into account on a jurisdictional basis, jurisdiction by jurisdiction. We came up with the blueprints waiting for better days, and the better days came. I mean, I'm not talking about COVID, because these were not better days. But at the same time as we had concluded the blueprint almost, there was the US election and the arrival of the Biden administration, which decided to make Pillar 2 an utmost priority in the US by strengthening guilty. They're still on it. You know, it's in Build Back Better, which is not yet approved and may be delayed because of the discussion of the Supreme Court justice, but we think will happen. Strengthening the minimum tax. The Biden program was to bring it to 21% on a jurisdictional basis. I think the current draft is just above 15%, but still on a jurisdictional basis. And the US, strengthening guilty, had to get the rest of the world to do the same, not to put itself at a competitive disadvantage. But beyond this issue, what is at stake is to reconcile middle classes with globalization, making sure that the people understand that the big players, the highly profitable companies, would no longer be able to use tax havens or low tax jurisdictions. And this has been the focus of the Pillar 2 conversation since February, which resulted on the 8th of October to the agreement that you have seen. A minimum tax calculated on a jurisdictional basis at 15% effective, which is pretty high. I know that some say, oh, your southern neighbor in Argentina, oh, that's low. That's not low, that's very high. Effective 15%? Nobody thought we would ever land at that rate. You need to compare that rate not with the domestic rate, which is higher, well, taxation of domestic activities. But usually, foreign source income through territorial system is not taxed because it's taxed by the other country, but it's no longer taxed by the other country, which means that today the effective tax rate was around 5, 6, 7%. After BEPS, probably 2, 3% before BEPS. Big change, which was agreed globally with an extremely complex mechanism. It is true it's complex, but the result is simple: safety net, 15%. Through the income inclusion rule or through the under-tax payment rule for companies above 750 million euros of turnover. Multinational companies, probably 9,000 multinational companies covering 92-93% of corporate income tax, of income, global income. We had to introduce a carve-out to recognize that some tax incentives were based on real activities had to be recognized to a limited extent. The limited extent is 5% of the payroll, 5% of the assets, with a transition period of 10 years, starting for the first 5 years in almost a flat curve and then decreasing fast, starting at 10% for the payroll and 8% for the assets. It's massive. I'm not sure we have yet measured the consequences of putting this floor to tax competition, but it really is massive. As regards Pillar 1, the Biden administration has come up with an extremely constructive and pragmatic approach. Pragmatism meant that for this to keep the support of both the Republicans and Democrats, even though we know bipartisan is kind of broken in the US, the fundamentals are that there is no ring-fenced approach. And one of the big weaknesses of the blueprint was that the segmentation between consumer-related activities and other activities, the former being in scope and the latter being out of scope, would have resulted in extremely complex segmentation, consumer-facing businesses being in scope and the rest being out of scope. Instead, the US came up with an approach which convinced members to move ahead, which is completely non-discriminatory, and say what is relevant is not consumer-facing or not, even though the roots of the reasoning were related to this marketing intangible. Let's move to address the real issue, which is where the IP is based, where it triggers massive revenues. And massive revenues can be appreciated based on the profitability of the company and the size of the company. And the US proposal was to start with 20 billion euros turnover for companies having a profit above 10% on sales. And this approach has resulted in covering a very significant chunk of the global profit, more than $500 billion a year. And the philosophy is to move to what many people have dreamed of, which is unitary taxation. You look at the financial accounts. You move away from the pure accounting, tax manipulated stuff. And if you are big, 20 billion to start, 10 billion after 7 years of implementation, if you are profitable of above 10%, then a quarter, and the quantum has been negotiated until the very last minute, the very last day. On the 8th of October, the quantum was not yet agreed, but it was at the end of the day, a quantum of a quarter of the rent, meaning the profit above 10%, to be reallocated to market jurisdictions based on sales, with a new nexus. It's the sales levels, which will determine whether a company is liable to tax in the country, and no more whether you have a subsidiary, whether you have a permanent establishment. And the level of nexus, which is pretty low, 1 million euros for the largest economies, 250,000 euros for the smaller economies. And with that, you have a shift to unitary taxation for the largest companies. What is the counterpart of all that? One, that these companies will benefit from tax certainty. Tax certainty in the determination of what we call amount A, which is this new taxing right. Tax certainty if there are further disputes down the line, with a real elimination of double taxation, which countries, all countries across the world, have been extremely bad at hiding behind sovereignty and pretending that arbitration was contrary to the sovereignty, which I think is a way out of just assuming your own responsibilities. The other counterpart was to rule out the digital service taxes. And you may have seen that there have been some agreements between countries, between the US mainly, who started trade retaliation, and countries having DSTs. There are other elements in the deal which I have not emphasized and I will just mention quickly before closing so that we have some time for Q&As. For Pillar 2, given the rule order, which looks like it favors capital exporting countries by the income inclusion rule coming first before the under-tax payment rule, developing countries asked and obtained, and developing countries here is broad sense, including emerging economies, a subject to tax rule. To restore the taxing right they may have lost through poorly negotiated tax treaties. And this is a minimum standard. If countries don't give it, they will end up being blacklisted. That's for Pillar 2. Globe rules, minimum tax, and subject to tax rule. On Pillar 1, you have amount A, but you also have amount B, which is a simplified approach with a fixed return for baseline distribution activities, which should provide simplicity both to the tax administrations and to the taxpayers. It's a low-hanging fruit. And people fight instead of getting this low-hanging fruit, but we hope we can deliver that by year-end, which is the time schedule. This is what has been achieved over the past 12 years. Tax cooperation building a community with a firm on tax administration, with a global firm on transparency, with a lot of technical assistance which has been deployed, such as tax inspectors without borders, where you can see that tax administrations, instead of being just domestic centered, have now moved to the global environment and are aware of the global environment and are exchanging information with many tools such as the country-by-country reporting or the common reporting standard. Second, the rules have been strengthened to address base erosion and profit shifting, to the point where we are now moving to a multilateral convention to implement Pillar 1 and to a global implementation of the model rules of Pillar 2. The model rules of Pillar 2 were agreed on the 30th of November last year, just on schedule. And they are already, if not implemented, but in the process of being implemented. The EU Commission, the European Commission, has already tabled or did table a draft directive on the 22nd of December, which is being negotiated, and the French presidency of the European Union is making this a top priority with the hope to have this text approved by March. The United Kingdom, which initially was a bit reluctant to Pillar 2, has started a public consultation with the view of incorporating the minimum tax in its domestic legislation in the fall. Switzerland, the poster child of the small investment hub, has already announced that they are going to change their constitution to implement Pillar 2 with a minimum tax of 15% by the 1st of January 24. So you can see a real move. And we are currently designing the rules, implementing into the details of the rules of Pillar 1. And there is a lot to do. I mean, there is a carve out for extractives and financial services, regulated financial services. You need to draw the line. Do you take downstream or not? If you take the extractive, which downstream? And so that's what we're negotiating. The revenue sourcing rule, there will be a public consultation soon on the revenue sourcing rule. Elimination of double taxation. Where do you take the money from to eliminate double taxation? The tax certainty mechanism. How do you compose the amount A panel in case of dispute? What is the process to manage the determination of amount A? With this tax cooperation of the background, this is where we are, and we have until mid-year to come up with a multilateral convention which will be signed by then. The consequences of all that are still to be measured and considered. I was 2 days ago in Kenya. Kenya is one of the 4 countries members of the inclusive framework which has not joined the agreement, and I hope they will be joining the agreement. And we were talking about the tax incentive. The impact of Pillar 2 on tax incentive will be massive, and that's where I think Pillar 2 will benefit massively to developing countries, which will be able to get rid of most of the wasteful tax incentives. But all that to say that there will be massive consequences. Whether Pillar 1 and Pillar 2, and I'm addressing questions which may come on, but you really think that the US will ratify Pillar 1? You really think that Build Back Better will finally be implemented? Yes, I do. I do, because this is the trend. This is where we're heading. It took us 12 years, which is small in history scale, to get there. And I think this is a move which is ineluctable. There may be some hiccups if countries do not implement that quickly. But the counterfactual is chaos. Countries moving unilaterally, double taxation, frictions, such chaos that companies at the end of the day, which could have been reluctant, which were reluctant against the BEPS project, for instance, will just ask for this to be fully implemented, starting with the US. So I'm not too worried there. And in this new environment, I hope we'll be able to put an end to the tax competition, the toxic tax competition, and to have a fairer system with more stability and more certainty for the taxpayer, which is something which is very important. Word of conclusion, to leave some room to Q&A. Brazil has been a very active participant. Not easy, and that's good, because Brazil has its own rules, and you know that the transfer pricing rules in Brazil, which we are working on with the Brazilian authorities, because Brazil doesn't comply with the arm's length principle for good reasons, in a sense, to protect the tax base, but also bad outcomes, because by thinking of being tougher, Brazil actually exposes itself with a number of safe harbors to aggressive tax competition or aggressive tax behavior by the taxpayers. So we're trying to work together to align the rules, because it could be one of the hurdles of Brazil accession to the OECD. We're well advanced in fixing these, and benefit from the new international environment will for sure be what Brazil will gain from the adoption of Pillar 1 and Pillar 2, with challenges on tax certainty and so, because Brazil, like many other countries, is reluctant to move there, but I'm confident they will move there because they need to move there. And not only to exceed the OECD, but to improve the business environment. So that's the balance we need to find, the balance which is, it was time to put an end to the extremely aggressive behaviors of taxpayers, because we didn't have the rules to regulate. We have now introduced international regulation of globalization, tax regulation of globalization, which means that we also need to ensure that we have stability and certainty. So I hope with that you have an overview of what we've been doing and where we are, and I would be happy to take some questions. So André, over to you.
Merci beaucoup, Monsieur Pascal Saint-Amans. You have given us a broad and comprehensive perspective of everything you've been doing. And I'm sure that our class has some interesting questions that they have previously prepared. So before opening to them, I would just like to emphasize that as the leader of the greatest tax revolution of the 21st century, what you're doing, Monsieur Pascal, is to avoid a new revolution against the status quo by showing to the middle class, as you've put it in your speech, that the upper classes are paying their fair share, especially due to the massive amount of assets and income that they have accumulated in the past 2 decades. So I would really take this time, I would really like to take this time and this space here to thank you for what you're doing to our global society. Having said that, I'll open up for our students, for our class, because they're eager to ask you some questions about your field of work, which is our field of study here at the postgraduate program. So following the alphabetic order, Aloysio, if you may start, please.
Sure, Professor André, thank you very much. Mr. Saint-Amans, it is a pleasure talking to you, well, again, because you probably won't remember, but 2016 Tillinghast lecture, NYU, you were, I think it was 16, right? You gave the lecture, it was about BEPS. I was doing my LLM back then, and I then realized that I was in the middle of a, well, as Professor André said, a revolution in international tax. It was exciting then, it continues to be today, and well, as you were kind back then as well, answering my questions, I see you continue to be so here today, joining us, talking to us. Thank you very much for that. Well, I guess I have a list of questions. Unfortunately, I don't think we're going to have time to go through all of them, and I wouldn't torture everyone with all of my questions. But maybe a general one is that with Pillar 2, Pillar 1, and even as I see at least, Pillar 2 as being a worldwide CFC rules, right? We see a tendency towards taxation of income without what we call here in Brazil and some other jurisdictions as without realization properly, without an actual distribution of those funds, right? In some jurisdictions, this is not a big deal, right? But Brazil, even for constitutional reasons, has a very strong tradition or legal basis in realization of income, right? And what I personally see is that the world maybe, I don't know if due to the innovations that the digital economy brought, is maybe transitioning to a system that taxes income without realization, maybe on a I wouldn't say net basis per se, but more tending to a gross basis, right? So I would like to hear you maybe a little bit on that. If you also see this tendency, if maybe it's an imposition of the digital economy, it's the only way jurisdictions can actually tax not on a net basis, but more tending to a gross basis. I don't know if I made myself clear.
Thank you. So I respond to this one, André, if you are fine with that, and quickly to leave some room to others. That's a very good question. I think you're right. It's kind of a move towards a generalized CFC, which neutralizes the default. I mean, there is no default. You tax on the accrual basis. So you're probably right. It goes beyond that because CFC usually will apply to passive income, while this doesn't try to make the difference. And that was the failure or the relative failure of CFC legislation. Because by just dealing with the passive income, I mean, it was missing a significant part of the profit which was shifted to low tax jurisdictions, not to mention the specific challenges in the European Union where you need to have an abusive scheme to be able to apply a CFC legislation, which really dismantled CFC within the European Union. And as within the European Union, you have low tax jurisdictions, you had no longer any form of minimum tax in Europe. And as Europe not only suppressed the domestic border, but didn't establish external border, you had the opportunity to shift the profit away from the European Union to Bermuda without any taxation. So you had no longer CFC legislation because of EU intra-EU rules. So you could locate part of your profit in a Luxembourg subsidiary, if you're in a French company, and you couldn't do your CFC. And for foreign companies, they could shift their profit away, and the US, because that's the main investor here we're talking about, couldn't do its CFC before the US tax reform. So is it a move to taxation without distribution? Yeah, probably. But in a globalized economy and a financialized economy, I'm not sure that really depending on the distribution is the relevant criteria. I mentioned that with in mind the example of Apple, which I think in 2012 or 13 distributed $50 billion of dividends, which they borrowed on the market because they didn't want to repatriate the money they had in Bermuda. So what does that mean? Distribution or realization where actually it had been realized, it was just not distributed. And I think we're moving to something which is much more neutral and probably more efficient. That would be my response.
Thank you very much. Thank you very much.
So, Christiane, I guess you have a question also.
Yes, thank you, Professor. Merci, Pascal. Ce fut un grand honneur de vous entendre, pardon. And my question is, probably, as you know, Brazilian tax practitioners, especially the transfer pricing specialists, they are concerned with the alignment of the rules in one important aspect for us, which is the tax certainty, which you mentioned. So my question is, do you think it will be possible for us to keep certain parts of our legislation, or it will be required for the whole process of adhesion and accession to the OECD for us to adopt the arm's length principle as it is, without any use of predetermined fixed margins and all the safe harbors that are not right now endorsed by the OECD? And even in the last version, which was published this month. So this is my first question. My second question, if you have time, is just what is the outcome probably for the Brazilians in general if we do not sign the MOI, because we have not signed it yet. So, merci beaucoup une fois encore.
Merci, merci pour votre question et votre gentillesse. Will Brazil have to change its legislation as a condition to get a member of the OECD? The answer is yes. The system today is not compatible with the standard. That said, we've just explained that the standard has changed, is changing. So you need to keep that in mind when moving ahead. It's changing because of Pillar 1. It's also changing because, for instance, in the context of the BEPS project, we recognize the fifth method, which comes from Latin America, which is a safe harbor of natural resources. And Amount B will be some form of safe harbor. If not a safe harbor is not the right word. It's not a safe harbor, but some more tax certainty, where you know through, we hope, a quantitative approach, you would have the price, which should help developing countries in particular. That said, you have a legislation where you have this fixed price in many areas when they depart from what would result from a transactional-based approach, each country to the standard and will have to be fixed. And I say it's full of opportunities for Brazil, because in a number of cases, this fixed price costs a lot to the treasury of Brazil. I mean, Brazil is very proud of having a system which is, bulletproof. It is not bulletproof. And the work we're doing, the Brazilian authorities, shows that instead of fully protecting the revenue, it actually exposes the revenue in a number of cases. So there is an interest, a strong interest, in changing the rules from a revenue perspective. Now, you're right that, and that's what we are investigating with the Brazilian authorities, and we've been working for the past 2-3 years now on this. There are cases where we need to do the cost-benefit analysis of the measure and see how we can move. But the short answer to your question is Brazil will have to change its rules if it wants to become an OECD member. And I think it's recognized. And the decision taken by Brazil to join the OECD was taken with that in mind. I could even say that some in Brazil thought that it could be a leverage against some of the conservatism of Receita Federal, right? I don't want to do internal politics in Brazil, but Receita Federal has its own approach, which is very great administration and very well respected, but also with conservatism, which sometimes is not necessarily the best. Now, as regards to the MLI, what happens if you don't ratify? Nothing in terms of sanctions, but you're just losing money by treaty shopping. Now, maybe some cronies love it, but that's bad for the country. So the best case for the MLI is it will save money for Brazil, and there is no obligation or burden on Brazil. It's just, I mean, a low-hanging fruit. Do you want to get it or not? That's your sovereign choice. But I think that the conservatism here, which is, oh, we don't want to move there, and I know that Congress is very reluctant to international instruments, but this one is just about the story I told you today. It's about regulating globalization. So you cannot complain that the tax base is weakened and not join international instrument which will protect the tax base.
Merci. Thank you.
So we are already over our time, but I would like to ask Mr. Pascal if he has time for one last question.
Let's go for one last.
Thank you, Mr. Pascal. So, Levenhagen, please go on.
Thank you, Professor. You all can hear me, right?
Yes, we can.
Okay. Well, first of all, thanks a lot, Pascal, for taking the time to talk with us. I know you must be really busy, so it's a great honor to be able to talk to you, especially because I started learning taxation, around the same time that the BEP started. So basically, I've been following it since the beginning, and talking to you is like talking to a celebrity right now. But anyway, what I wanted to ask, Christiane kind of already asked, so I'm going to ask a following question. I was going to ask you if you think that Amount B from Pillar 1, due to its similarities to Brazil's TP regime, at least, the philosophy of using fixed returns, kind of trying to simplify the system, if that was like an indicative that maybe moving forward, transfer pricing regime will start integrating these simplifying mechanisms. But you kind of already answered, but if you want to complement that answer, it's okay. And then the second question that is, the one that I came up with afterwards is, could you elaborate a little bit on the relationship between the top-up tax from Pillar 2 and countries that have a strong CFC regime? Because it seemed that there will be like some kind of overlap there, such as Brazil, really. So those would be my questions. Thank you a lot.
Thank you. Very good question. As regards to transfer pricing, yes, I think there is a strong appetite, especially as now developing countries are on an equal footing in the decision-making at the OECD on tax. I mean, Brazil is going to join the OECD at large, but Brazil is already a member of the OECD as regards taxation. So you are influencing the process. And yes, you see a convergence towards, a convergence between the Brazilian regime and the OECD traditional approach, because Brazil has to change. And I think it's recognized that it's not only a constraint, it's a necessity if you want to avoid some profit shifting outside Brazil. So you need to change and move towards more transactional, because full tax certainty, and that's a paradox, and business doesn't like me saying that, but full tax certainty is the perfect recipe for tax avoidance. Because when it's absolutely certain, you just need to check the boxes, it's enough to change one box, not to be covered. So you can plan accordingly. So at some point, a fact and circumstances analysis, which is less simple, but provides more responsibility. So moving towards transactional-based approach is not that bad, and Brazil is going to do that. And the OECD has to recognize better, and we started that exercise, that more tax certainty, more simplification is necessary, and developing countries need more simplification. So there is some form of convergence, and that would be the response to your first question. The second question on CFC is a very good question, and I concluded quickly by saying we're in a new environment and we may not have measured all the consequences. I mentioned tax incentives, the impact on tax policies. That's one. You're right, there is another one, the other dimension, which is what do you do with your CFCs? And some have raised that in the European Union, for instance. You may remember that the EU, when translating through the ATAD directive, I think these are the ATAD directive, the BEPS project, they strengthened CFC, or they did put minimum standard on CFC legislation. What's the impact of Pillar 2 on this? Do you need them or no longer? And maybe there is a reflection to start there, which may depend, and there may be no one-size-fits-all answer to that, but that's a very good question. And we are just at the beginning, I think, of a process where we will have to digest Pillar 2 and see what the consequences are from inbound, outbound tax rules, and that's ahead of us. And that's pretty exciting from an intellectual perspective.
Thank you, Mr. Pascal. On behalf of our class, of Professor Fernando, myself, of the postgraduate program of the Federal University of Minas Gerais in taxation, I would like to thank you very much indeed. And we can only hope that the inclusion of Brazil as an effective member of the OECD won't take long, since on the 25th, we've started the process. So thank you very much again. It's been a pleasure and an honor to have you here.
Thank you. Muito obrigado. Thank you.
Bye-bye.
Bye.